Okay, good morning and welcome to the third and final instalment in our three-part series of K3 Hub webinars, focusing on a range of topics aimed at helping businesses prepare for the post-pandemic world. I'm Simon Bonney, a Managing Director in Quantum's Restructuring and Insolvency team, and I'll be your chair for this morning's discussion. Last year, as many of you will know, we merged with K3 Capital Group Plc, and since then we've launched the K3 Hub, a member network for professional advisors developed by us and other parts of the K3 Capital Group, including RAND, K3 Tax Advisory, and K3 Debt Advisory. Free to join, the club gives members access to a whole host of services, diagnostic tools and calculators, insights and news and CPD accredited events via a bespoke website. You can find out more at www.k3hub.co.uk. Before we kick off, I'd like to ask for your patience if we do experience any technical difficulties at all during the next hour or so. The Q&A function is open on this webinar, so please do submit your questions and we'll endeavour to answer them as part of this discussion. And if we don't get to any of them, we'll make sure that we come back to you afterwards. So, without further ado, let's begin. I'm delighted to be joined today by my fellow Quantum MD, Louise Durkin, Adam Zolden, who is a Director at Knights Corporate Finance, Carl Holmes, Managing Director of K3 Debt Advisory, and Holly Bedford, Managing Director at K3 Tax Advisory. So to our case study. We've been looking at our fictional group, CS, which is an electrical retailer and wholesaler. CS has had some challenging times through the pandemic and has made use of government support, including the furlough scheme and VAT deferral. It's experienced poor trading on the physical business, with a lot of the stores having been closed for a lot of the pandemic, but has been a winner with its online business, which it now wants to focus on and grow with a view to an exit. Therefore, the business now wants to look at winding down physical and maximising online's growing turnover from 12 million to 35 million and increasing EBITDA from its current 2 million to somewhere closer to 6 to 7 million. So no easy task, but as with all these things, very possible with the right plan. So Adam, coming over to you, what are your initial thoughts on the strategy for the business in trying to grow online?
Thanks, Simon. Hi there. So interestingly, despite COVID, the sort of the market for raising money and transaction activity has been pretty buoyant, particularly in those areas that haven't been affected by COVID. So our view is generally, well, let's start at the end. Where do you want to get to? And then we can plan from there. And clearly, for online, they've developed a good plan which we can work to. So from where they are today at £2 million, really they should have a good variety of options at that level of EBITDA. They should be able to raise money either on a debt basis, which will generally be at a lower multiple of their EBITDA, but they should also attract some interest from the lower mid-market private equity guys as well. And that will enable them either just to raise some growth capital or perhaps take a bit of money off the table, as clearly they've got a lot of their wealth tied up in that business.
And how important in there, Adam, is that concept of the plan, having a plan and sticking to it and revisiting it?
Well, it's having the plan and having the people behind the plan. So as a management team, you're going to need to be credible, and that your investors or funders are going to need to buy into that team, and they need to be able to articulate how they're going to do what they say they're going to do. So, business planning is important. A clear financial model is important. Everyone understands that it's not going to be right, but it needs to show what is possible and needs to be able to demonstrate, where the key sensitivities are. So, yeah, the number one investment criteria is the team.
And so, in terms of those options, I mean, we're talking about a business that wants to increase from, I suppose nearly treble its turnover and indeed its EBITDA, if not a bit more. So what types of options will that business be looking for in terms of how it grows?
Well, I mean, clearly, that's a big ask on organic growth over a period of time. So it seems quite likely that somewhere in there's going to be some inorganic activity, some acquisitions, and so on, and that almost certainly is going to have a funding requirement, and that the type of funding that they want is there are options, there's alternatives. Certainly there will be debt available, but there'll also be the equity investment. The equity is expensive, so perhaps initially debt might be preferable, but if shareholders are thinking, well, we've built up a good business here and all of our wealth is effectively tied up here, then private equity not only will bring along sort of growth money, but also allow shareholders perhaps to take a bit off the table at the same time and incentivize their next level of management.
And so before I bring Carl in on the debt side, looking at that kind of private equity or VC side, a business of this size, is it big enough to generate interest within the PE or VC market?
Yeah, that's been sort of an interesting development over the last few years. I would say that at 2 million EBITDA, they're almost certainly to attract some good interest from the lower mid market. We're seeing good levels of investment at that level now. Depending on the sector, it might even be lower, but I would say 2 million is a safe level.
And I suppose with that, you're not only looking at a PE or VC funding the business as it currently stands, but funding it with that kind of wider picture of what the picture would be, were, for example, it to make an acquisition, and looking at that journey and going along that journey with them.
Yeah, the private equity doesn't just bring money. It brings a certain level of skills to professionalize the business, to incorporate disciplines, really to get it ready for the next transaction in 3 to 5 years, when hopefully it's hit that 35 million target, and ensure that at that time it has all the structures and disciplines in place in order to move it on at a significantly enhanced multiple, maybe to a trade buyer, maybe to a larger private equity player.
And how do you find the kind of, I suppose, the psyche of owner managers when there's this first step into the unknown of bringing in third parties who are perhaps more corporate in their outlook, more ruthless in their challenging of management on what they're doing and why they're doing it?
It's a very interesting one. People have different perceptions of how private equity are going to act. The first thing is they're not going to run your business. They don't want to do that, and that's not what they do. Our advice is always go and meet a few, because what you will find is that all of them will have different aspects that may appeal to different businesses. Some may be focused on international expansion. Some may be more driven on, may have more experience on developing online presence, or some may just be keen on originating UK-based acquisitions. And it's a very personal decision in the end. The money is one thing, but these are people that you are going to have to work with over a period of time, and you need to meet them and understand that they are good people to work with, or people that you want to work with.
Yeah. Thank you, Adam. So Carl, coming to you, our case study is one who is, they've used their funding options in terms of the government support packages. They've already got debt within the business in relation to assets, but now obviously, as Adam mentioned, debt is an option for them in terms of looking to fund or part fund this growth strategy and try and get to that 35 million and a healthy EBITDA multiple. So what, in this type of scenario, where the debt may not necessarily be attached directly to the assets, what are the options for online in terms of debt funding?
Hi, Simon, and hello to everybody on the webinar. Yeah, it's an interesting one, isn't it? I mean, there are a number of issues here. The primary concern from a debt perspective will be the quality of earnings and making sure that the underlying EBITDA will support serviceability of the debt. And given the fragmentation of the debt market, there is a range of ways of addressing that. If you were to go to a more traditional high street or one of the more traditional sort of challenger banks, then you're still going to see very much an amortization profile and an ability to repay the business and a good headroom requirement. If you go to one of the more entrepreneurial debt funds, then you may well be able to change that structure so that the amortization is back-ended, so that the business, the lender is more prepared to go through the capital structure and maybe take an upside in almost equity risk if you get to the right level of funding. So, you know, you will have options to look at, and to a great extent it'll depend on what makes up that underlying EBITDA. You know, at the moment we're talking about online retail. That retail of itself is not something that's been hugely popular with lenders. There are certain lenders that will specialize in that sector, but it's not generally it's perceived to be, you know, an interesting and challenging environment, and one that's going through a lot of change. If by some way they were able to convert some of that earnings into recurring revenue with a subscription service, for example, that would really support a debt proposition much better than an ordinary retail environment. So, you know, there are a number of levers that they might be able to pull in order to improve the debt proposition.
And do you think that the debt market has been affected or will approach things differently, given that the balance sheets of March 2020 have materially changed with the impact of COVID over the last 18 months?
Yeah, I think there's a couple of factors that we need to think about. One is the preferential claim for HMRC arrears and things. So we need to be clear about what debt on the balance sheet might impact on the lender's position if it's a floating charge cash flow term loan. I mean, you'll have a fixed charge there, but it's whether there are fixed charge assets to support that. And also what schemes are available. So the recovery loan scheme is in place. That's a follow on from the CBILS scheme. It does allow borrowers to lend a certain amount of money, guaranteed by the British Business Bank up to 80%. It allows you to borrow for growth, for acquisitions and the like. So it is a flexible scheme. Currently, it is penciled in to finish at the end of December. So, you know, clearly that's not going to be there to support a long-term growth strategy. So that's one of the factors that hopefully the government will look at extending that and give that kind of support, which takes into account the impact on performance and valuations that have been caused by the sort of short to medium term impact of COVID.
And I suppose I have this impression that, you know, on the equity side, you've got people who buy more into the story. They understand where the business is going. They understand that there is a strategy to get there, and therefore there is a perception of you know, being able to make an informed decision based on a whole picture. Is that true on the debt side as well, or would the debt funders be, I suppose, much more formulaic in the way they're approaching whether they're willing to put out money in this type of situation?
Yeah. I mean, debt is going to be less likely to extrapolate the hope value. You know, so if you've got a proposition to go from 2 to 7 million EBITDA, that can be exciting from an equity perspective, but from a debt perspective, you're wanting to see the building blocks that make that up, and to the extent that they are, this is what we can do, there's a clearly less certainty from a debt perspective than there is, as I say, opportunity from an equity perspective. So, you know, come back to Adam's point, it's all about having a very good plan and really demonstrating the assumptions that underlie that and allow them to be really robustly tested in terms of sensitivities and things. If, for example, you're going to acquire a business and that generates, 4-5 million of EBITDA, then clearly the lender can see that. But then there's also the issue that that's going to be expensive. So you're not going to get the leverage, unlikely to get the leverage to match what the vendor's expectation is. So the debt is going to be much more around what has happened in the recent past, subject to what you might take into account with the RLS, and what can be seen is going to happen in the short term. You're not going to be able to run over the edge of that cliff and keep running like they do in the cartoons. You're going to fall to earth pretty quickly.
But is it true to say that you will have some debt funders who are entrepreneurial in the sense that they will put in debt, but they will also, I suppose, take some form of view on trying to benefit from upside and kind of price that into the whole package?
That is true, and there are debt funds out there. I mean, the scale is an issue. The cost of funds is expensive. They need to see a big return. They need to see a money return as much as a percentage or multiple return. So sometimes it's difficult at the level of 2 million EBITDA. You're probably starting to register interest with some of those, but scale is very much an issue in terms of that more entrepreneurial and quasi equity kind of lending.
Okay, thanks, Carl. Holly, coming to you. Before we go on this journey, we've obviously come through 18 months of challenge. We have a business which has a good level of turnover and healthy EBITDA, but obviously has aspirations of achieving a lot more on the online side. So from a tax perspective, is there opportunity to put in place now building blocks to manage the business going forwards from a tax side, and advantages that can be taken before this journey started?
Yeah, so one of the sort of important things to think about when the business is going on this journey is taking the management team with you. You're going to be relying on these people to build this business with you. And a great thing to do when you're maybe at a lower valuation and you're planning to get higher is to put in place some kind of share-based incentive scheme for your management now. While values are lower, it's just more tax efficient, more affordable to bring management in now into an equity incentive scheme. And because when we say equity, we mean shares, basically shares in the company. And because they are either shareholders or share option holders, they're incentivized to grow the company in the same way that you, as the founder shareholders, are incentivized. So it's about aligning objectives, giving them a slice of the action, making them feel like they're part of the journey. So that's a good thing to think about now before the growth gets going.
And so on that share incentive scheme side, are there it's not something I've come across particularly regularly in what I do, but are there barriers to entry? Are there reasons why people don't go into those schemes, or is it quite typical where you've got a kind of entrepreneurial management team?
We do see a lot of them. They are very commonly used. My experience, one of the barriers to entry is if shareholders don't understand all the options or the choices that are available to them to do this. They just think, I don't really want my employees to be shareholders. I don't want them to be having votes. I don't want them to be turning up to meetings, asking for sets of accounts, whatever. I don't want to give them that level of involvement. But the way that we deal with that is something called a share option scheme. So the employees have a right to shares, and it's as if they're shareholders, but they're not actually shareholders until the point where there's an event, say you're selling the company or something, where they can share in the value. They're just option holders. They don't have any rights to meetings. They don't have any rights to voting. They don't have any rights to know things that the shareholders might be talking about. So that does take away that, just that practical kind of commercial concern about maybe telling people things you don't want them to know along the way. So I think that can make it a lot more attractive to companies that have previously been quite closely held within a small group.
I have this image now of hundreds of professionals a few years ago sweating over the concept of converting their old-fashioned partnership into an LLP, because the idea that anybody would be able to see inside would be scary. Adam, from your point of view, presumably that type of incentive scheme, the VC side, they want to see management incentivized, and they want to see they're bought in.
Sure, yeah. PE is, I mean, they started in management buyouts really, so they're all about the management team. But if at this first stage where we're at, the key shareholders are probably going to stay in and continue some management role, but it's still important to bring up sort of the next level, because they're going to be the ones taking over the reins at the next transaction. And P is quite good at that. They generally introduce a structure which enables management to buy into the equity, generally a strip called management equity or suite equity, at a fairly discounted price. It's a headline discounted price. It's not really, but it works well, and it's quite a common theme. So, I mean, share option schemes are common and popular. They're good, but if the immediate requirement is some sort of private equity transaction, then the likelihood is that the two things can be incorporated at the same time.
And that idea of a situation in which you've got that, you want to have management bought in, but also you're probably going to want management who quite like the idea of getting some cash off the table at some point, de-risking their position.
Yeah.
In a transaction with PE, are they going to be supportive of that type of process, or are they going to want to see management kind of all in on these situations?
Yeah, it's they do want to keep you hungry. It depends who it is. If it's shareholders that have been in the business for a number of years, and just they'll understand that they want to release a bit of their wealth, and that's understood. If they're going to stay on, and if they're important in driving the business forward, they're not going to let them take 90% of their money out, but quite commonly we see 50% or something like that. For the next level down, it's unlikely that they'll be able to extract cash at this transaction point, but from their perspective, it's all about drive the business to the next level, and that's when you'll be making your money.
Okay, thanks, Adam. So leaving online to one side for a minute as the beacon of positivity, now we'll focus on what the group needs to do with physical and winding down that side of the business. It's often a situation in which you have a management team who's good at those certain aspects of the business. You've got people who are very good at sales, very good at operations. But obviously, it's naturally speaking, people aren't inclined to the principle of winding down their businesses. They're inclined to the principle of winding them up. So, Louise, for you, in terms of the physical side of that physical retail business, has some freeholds in it, is still balance sheet solvent, but has been making losses. What are the options for winding it down?
Yeah, and you're absolutely right. There's a great positive story on the growth side of the business. And so I guess, talking about keeping management on board and incentivized and sort of motivated, if you like, to do everything that requires that growth. And this is something that still will be, valuable to the business and in the longer run if you get it right. And I think it's important by just beginning, as we've said, with the growth strategy, it's what's your plan? It's looking at assessing the options of what can you do with that business. Are you winding it down over a period of time? What sort of outcome is that likely to bring you? You've got some freehold property in there. Are you looking at the valuation of that as a property standalone transaction, or are you looking at it potentially not winding down that business, but maybe selling that business off? So it's really looking at the strategy around those two options, looking what those outcomes could give you and forecasting to the best of your ability what those scenarios are going to bring you, and potentially looking around the timing of this as well. So is actually a transaction, is there a particular point at which you think that business is going to be prime for a transaction? But it's looking into some of the detail behind these stores, who's performing, who's not performing, looking at the stock levels they may be carrying, looking to see whether there's discounting that you can apply in there to increase footfall. But making sure behind all of that, those that are making the decisions and the management team that sit there and have to work that plan through, have you got the right skill set in there? So yes, as much as there may be a very exciting element going on in the growth strategy, it's equally important to have the right skill set on the wind down strategy as well.
And presumably, probably something that a lot of people don't take enough time to consider is the impact of management time depending on a strategy. You know, I suppose if you take a strategy of wind down over a period of time, and the forecast is that that's going to generate 5% more than you were to undertake an alternative, but the alternative was now and finite, then you've got to appreciate how valuable your management time in directing it in the right way, don't you?
Yeah, it's hugely important, and you know, we can start out with an assumption that actually the wind down may bring greater value, but it's going to take quite a long piece of time, and you do get some management fatigue within this because there's a plan and it's rolling out, and it just feels that you've got to sit there and wait for things to happen. So if that is the strategy that you're taking, it's monitoring how are you performing against what your original expectations were. And there is some balance there to be had to say, well, actually, if we did take the slightly less valuable outcome here, but actually it frees up management time, and actually that pushes back into the growth and all the other things that online are looking to do, does that in the longer run take us to a better place? So there's some real tough decisions around that, but having your plan, monitoring against performance, are you hitting the targets? And as I say, there could be a timeline against this, and looking to see how those stores are performing over time. You know, sometimes when word gets out, you get a rush initially, so your sales might be up, and sort of all of a sudden everybody thinks everything's at a high discount, but it can take a longer time, and you end up bulk discounting, and your expectations on returns start to diminish. So yeah, keeping an eye on what's going on, and keeping management incentivized that even though this business is coming to an end, what they're doing is positive in the bigger picture.
Yeah. And Adam, from your point of view, you know, instinctively, why would anyone buy a business which is loss making? So is a disposal of physical a real possibility as an option to essentially, you know, have that finite ending quickly and move on to focusing on online? You're currently muted, Adam. It's that horrible moment.
Someone had to do it. It could be. I mean, in other sectors where there's fast growth, then yes, certainly we see quite a lot of sort of loss-making transactions. Here, I guess it's whether or not there is a buyer that either would particularly value the footprint, the geographical spread of locations, whether there's a level of expertise they require, or whether there's some, you know, some significant cost savings they think they could take out of that business. All of those things will feed into their view of, can they make a return? Can they generate a profit from what they have here because of that? And I guess you know, from an advice perspective, that's part of our role to say, yes, we can. We're success-based guys. We wouldn't start this transaction unless we could tell you, or perhaps, you know, maybe we need to pass it over to Louise.
Yes, yeah, I mean, it's absolutely right, isn't it? I suppose you can't always assume that your view of the business is the only one that's relevant. So for you, Louise, in terms of, let's assume that the business has wound down, and it's left with minimal assets except the freehold side. What are the options in terms of formally bringing it to a close?
Again, it comes back to sort of revisiting, did you have an original plan of what you were trying to achieve here? And I think the reality is that if you're winding it down, you're ultimately being left with a pile of cash and some properties. So is there another plan there as far as the properties are concerned? Is that something that actually from the management structure and from the shareholders' perspective forms part of a wider strategy? So are they looking to retain those freehold properties and not sell them? So actually, do we want those to be distributed back up through a liquidation process? Or are they looking to sell those properties? So essentially, you know, when you're coming to the end of the life of a business, and if it's on a solvent basis, you can wind that company down. You could ultimately have that company struck off, or you could liquidate that company. And typically, we're sort of looking at businesses that have been trading of late. So there's been activity in this business. So we wouldn't be recommending a strike off unless management were absolutely convinced that they'd done everything they needed to do to bring all connections and all contracts and relationships within that organisation to an end. But essentially, you're looking at, you know, can the business be liquidated? Can you dissolve it ultimately and strike it off? But it's again down to the management's attitude and appetite at this point in time to make sure that those final loose ends are dealt with properly. And a liquidation process on this occasion, I think, would probably be the right way to go. It does make sure that that company is brought to a conclusion, matters are dealt with, and then we're looking at what happens as far as any remaining assets, frankly, whether there's property or cash, distributing those back up to the shareholders.
Thanks, Louise. And Holly, from your point of view, you know, let's go back a step. Let's say that we're at the start of the wind down process, and it might take the next 2 years for them to enact that process on the physical side. Are there tax considerations that they should be making at that time to decide how best to manage that wind down process, what options they might have in terms of the freehold properties?
Yeah, so in this scenario, we have group. So we've got a holding company sitting on top of the physical company and the online company. So you've got to think, if you just wind down that physical side of it, the assets still stay within the group, right? The shareholder is holdco. So the property, if it's not actually sold externally, it ends up sat in holdco. Any cash ends up sat in holdco. So that might be a good thing. You know, the group might be happy to have that cash available to put into online, or it might feel that, you know, they can still use some of the properties within the group, rent them out or whatever. But if it's more that you think actually the shareholders might want the cash that comes from winding down that side of the business, particularly if the property is actually sold, and that ends up with even more cash in the business. One of the things that we can do if we're given enough time is it's called a demerger. So we split the group in advance. We split out physical and online, so that when physical is wound down, all the stuff goes directly back to the shareholders rather than getting stuck in the holding company. We can't really do that just before, you know, we decide to wind up a company. So again, it's one of those things that it's a long-term planning point. And if you're starting to think, you know, this the future is this, then that's definitely something to look at, because we can get money directly back to the shareholders in a capital form, you know, lower tax rates, rather than it getting trapped in holdco, and the only way to get it out is by paying them dividends at quite high, you know, 38% tax rates.
Thanks, Holly. Okay, so physical has been sorted. Louise and Holly have done their work, had a fantastic result, and now the focus is back on online. And I'm delighted to tell all of you that we have now identified a potential bolt-on, an £8 million turnover business with £500,000 EBITDA. And the attraction of that deal is obviously it adds good revenue to the business, but also it strategically, it has a recognized electrics brand within it. And the business thinks that it will really assist in getting them to that £35 million target. So in terms of those basics, Adam,
Yep.
Day one, I sit down with you as management and say, look, we've identified this target. Can you tell us what this transaction will look like? What might we think about? How are you starting to advise on that process?
Sure. I mean, the interesting bit will be whether you've identified the target, or we've identified the target as an off-market opportunity. The likelihood is, if it's a good business, they will have an advisor on board. That advisor will be digging into the numbers and trying to identify costs that would not recur post-completion, effectively a maintainable EBITDA. That's likely to push the profit from 0.5 to a maintainable level of 1 million, and they'll be marketing it out to a number of other businesses as well, in order to extract the highest possible or the best value for their client. So let's assume that the value there pushes EBITDA up to maybe £1 million. Now that's the drawback of dealing with an acquisition on an advised basis. You normally would pay a bit more. But the upside is the fact that they have a professional advisor on board is going to make the deal easier. Dealing with owner managers on an unadvised basis on a transaction that's likely to last maybe 4 to 6 months isn't easy. There's a lot of work involved. There's a lot of preparation involved, and there's normally a lot of emotion involved as well, particularly at the end game. And so just having that middleman involved on both sides takes a lot of the stress out of the deal. It means that it will be well project managed, and the diligence side as well. You end up, typically you should find that you're buying what you think you're buying. So from that perspective, that would be the first point. That would be the first point. What you'll need to do in order to get yourself a seat at the table is to come up with a valuation, and that's generally based on a multiple of EBITDA. I mean, standard UK valuations for relatively small owner-managed businesses tend to be around the 5 to 7 times EBITDA, unless there's something particularly special, IPR growth or something else in there. And so that's, from that point, you'll then need to make sure that the funding's in place before you are likely to get your offer accepted to move on with the next deal.
And on a turnover basis, certainly, and depending on, as you say, how much you can enhance the EBITDA, this is likely to be a relatively transformative deal for online. So what types of parties would you be anticipating would look to fund this deal? And on advising management, given the kind of potential numbers, where would you be advising them to go in terms of raising money to the extent they need to fund a deal like this?
I mean, I would say it's debt in terms of growth acquisition. There should be plenty available out in the market. The interesting thing is, if you already have your private equity investor on board, the debt raise should be significantly easier, because the debt providers gain confidence from knowing that they're sitting ahead of an institution that's already invested their money. But yeah, raising money for acquisitions at the moment, the market seems generally open, and generally you can also raise the money on the pro forma total EBITDA of the enlarged business as well, which means that the levels that you're going to require are easier to meet.
Okay, and Carl, from your point of view, looking at this type of deal, what are the funders going to be most interested in if you're going down the debt route?
Yeah, come back to the point that we made earlier. It's about making sure that they thoroughly understand and are comfortable with that projection. You know, if you're saying that you're being able to add EBITDA of $1 million to what you've already got, then they'll want to give that a good kicking and make sure they're comfortable that that's right. They'll want to be comfortable that the management team in place has got the ability to manage that transaction, and you know, the commercial risk and operational risk associated with that is under control. And that you know, is another point to add to Adam's about not just having the money in place, but also having the expertise in place of a private equity or you know, maybe a high net worth, or someone who's been through that process and has demonstrated their ability to achieve what the plan is asking for. But again, Adam's right. You know, once you get into that sort of growth area and you're looking at driving forward, and you can demonstrate that the business is on the up, and you know, hopefully the acquisition itself will have assets, won't have necessarily had the same sort of level of government support or HMRC, so you can generate more funding perhaps against that, in order to get closer to the mark. And you know, structuring will include speaking to the vendors about whether they're prepared to leave some money in the current very low interest rate climate. Sometimes a vendor loan note with a decent coupon on it is an attractive proposition, so you may be able to find a structure that works completely around debt.
And I suppose that's the key, isn't it? And Adam, I firmly get the impression you are reticent to whoever advisor or owner manager to be giving away equity too early, or certainly at too cheap a price. But practically speaking, if you're innovative about the way you approach it, let's say this business ends up with a £5 million price tag on it. You know, practically, firstly, not all the consideration is going to be due on day one, but there are different ways to be able to raise that funding and not have to sell equity in the acquiring business in order to raise that money.
Yeah, I would certainly protect the equity. If there is a particular individual in there that could be transformative, then maybe think about that. But generally, we see deferred consideration as normal. Now that deferred might be for a short period, just to check there's you know, nothing materially wrong, maybe 3 months, or if the target you know, has particularly strong growth plans, they might be happy to accept a longer period with a performance-based criteria as well, an earn-out, which I would say typically maybe 12 months. We've seen them up to 5 years. But what that does, it reduces the amount of cash outlay on day one from 100% maybe to 65 to 85%, something like that.
And just touching briefly, Adam, on the DD process. DD is a phrase that lots of people are familiar with, especially on the advisory world, but not many people either go through that process or understand a lot about it.
There's a big fear factor about it as well.
Yeah, absolutely. What's its real purpose?
It's verification. We've got a company, we've got our new funder, and we've got our investor on board. You complete the deal. You do not want to be going to the first board meeting after the deal and say, actually, we didn't realize this after spending all your money. So due diligence is a verification process whereby you're kicking the tires and ensuring that everything you've been told about the business is true, and there's no skeletons in the closet. You know, the perception, again, it's that it's used as a blunt instrument for a cheeky price check. My view is that those days have been past. You know, we're on a 3 to 5 year growth plan to build the business to £35 million. We're not interested in knocking 200 grand off the price. We want a team that's motivated and wants to work with us post deal. So it's purely for verification, purely to ensure that you know, the cash flows and the profit continues to flow as we expect after the deal. And we want to get the deal done because it's an inherent part of our growth plan.
Duly noted. And Holly, from your side, I'm constantly bemused as to whether the government is launching incentives to get business going and get deals done, or closing every loophole they possibly can. So in reality, you know, tax is always a side of these things. Are there any tax considerations that you would be encouraging someone to look at when they're specifically when they're approaching this type of deal?
So if you're buying a company, then you're buying all of its tax history. So diligence is very important to check, you know, what you might be buying, if there's any skeletons in the cupboard. If you're looking at an asset deal, then sometimes that can be a really good thing for the buyer, because you're buying an asset, you're paying, you know, an amount of money for that. And if it's the right kind of asset, you can then take tax deductions as a kind of depreciation or amortization of that asset. So if the company's capital intensive, if it's got, you know, heavy plant and machinery, then that can be beneficial for the buyer. If it's more that there's not a lot of capital assets, and so what you're really looking at is goodwill, that's where the revenue keep on changing their mind as to whether goodwill's a good or a bad thing. Sometimes they go, oh, we should make it just as good for people to buy a company as an asset deal, and then they change their minds, and they change their minds again. At the moment, it's hard to get a tax deduction for purchase goodwill. The scenarios in which you might be able to get one, and therefore it's a good thing to do a trade and assets purchase from a tax point of view, is if the company also has certain kinds of valuable intellectual property, and it's a very narrow class. It's things like patents, registered designs, and copyrights. So if you're looking at something in that kind of industry who might have valuable assets of that nature on their balance sheet, then buying that company's assets means that you as the buyer can then claim tax deductions going forward for the price that you've paid for those assets.
Thanks, Holly.
Makes sense.
No, absolutely. But I suppose for Louise and I, we live in a world of business and assets always, not the sale of shares, and we approach it from the point of view of that's a lot safer world to be in. And I know Adam has his views on these things, and we'll come to that in a minute. But Louise, from your point of view, you know, let's say, as Holly says, we do our DD, we're inheriting the tax side, and online realizes that actually there is some big tax problems in this company, and whilst everyone thought it was solvent, it probably isn't, and it probably isn't going to be in a position to be able to settle all its debts if there is a business and asset sale, and online realizes that it doesn't want to inherit the historical skeletons in the cupboard. So are there still options in that scenario to be able to acquire what online wants to be able to acquire?
I mean, the short answer is yes. But as we've just started to dive into a little bit, it's a very different type of transaction that you're going to enter into. And I suppose, you know, from that starting point is it's understanding what is the transaction, what do you get, what don't you get. You may not get some of the stuff that you don't want, the bad stuff, so you may be able to leave behind some of these issues, these skeletons, some of the liabilities, but what are you actually getting your hands on? So yes, it is possible, but the type of transaction that we're talking about, particularly if it's an insolvent transaction, it's more than likely that you could be acquiring the business therefore from an administrator, and administrators have very different types of contracts, and so what you need to be considering is, based on what you're getting, how are you going to reflect that in your price and in the structure of the transaction. You're not going to get any warranties or guarantees from an administrator. There's opportunity arising out of this transaction because you are able to pick up the business and the assets that you want, so you can be very prescriptive if you want to as to what you do or don't want from the assets. You can carve out in whatever combination you want of those assets without taking the corresponding liabilities. But there's still risk around that transaction for a buyer, particularly one that doesn't fully appreciate what you're getting your hands on, or what you might not get your hands on, or what might fall away. And I know Adam and I have an interesting dilemma. My view is, if you enter into the transaction with your eyes open, with good advice, you can do it. I know Adam's got a similar concern in terms of, you know, what acquirers really want. So for us, we would be encouraging people to take advice around the kind of transaction, understanding what you get. I act as an administrator, so I know what I'm selling. Does the buyer know what they're getting their hands on? And there can be some trips and some triggers there for you if you do not know what happens 1 minute after that business becomes yours, those assets become yours. Do you really have everything that you want? So do you have the contracts? Do you have the people? Do you have the relationships? So there's going to be some practical stuff that you're going to need some support around. And if you know that in advance and you can reflect that in your price and you can get a good deal, then I'd be saying yes.
Go on, Adam, you have the right to reply.
Well, look, the price is clearly important, and I would agree the deal is going to be simpler. So you have those two huge advantages in the run-up, you know, having done the deal, but day one, post-deal, there's a lot more work involved. You are buying a bunch of assets that were previously all held together by an entity that's now gone. So in terms of, now, the most important bit, the bit you're really buying is likely to be the customers and the customer contracts. All of those contracts with a different entity that no longer exists. So they need to be assigned. That is more than likely to cause some attrition. And it's it's some degree of work. You might not get the bank account. So the bank account will have to be moved. If there's direct debits, then they can be transferred as long as you have the same level of DD guarantee. But otherwise, it's calling the customers again and ensuring that they've got the right bank account deals. The likelihood is they will pay some money if they do pay into the wrong bank account. Supplier contracts might have a change of control if you've got some key suppliers. They might have the right to terminate on change of control. I mean, they're examples, but the point is, it's yes. In the run-up to the deal, simpler transaction, most likely lower price. After the deal, a bit more ball ache or a lot more ball ache. If you're on a 3-year buy and build, you just have to, work out what your priorities are. If in terms of, is this going to be the only deal we do? Because if we're going to do 2 or 3 more, do we really want to have this work to do in between those in what is a fairly short timescale?
I think it brings back to the point again, Simon, about your management team and the strengths and the skills within your management team here. We're trying to achieve an awful lot. We're trying to grow. We're trying to wind down part of the business. We might be taking on a more challenging acquisition, but it might be, from a pricing point of view, very appealing. But it's the time and effort and the resource going into all of this. And this is a thread throughout everything that we're talking about. It's both the skills, the appetite, and frankly, the resilience and strength within that management team all the way along to deliver what you're trying to do. On paper, everything sounds really good, but you've got to have the people behind it to deliver.
Yeah, I think Louise and I have acted on both the seller side as administrators, but also on advising acquirers trying to buy off administrators. And as you rightly say, Adam, the biggest risk, I think, is that you have an acquirer who thinks that the deal the day afterwards is going to be the same as a normal solvent transaction, where they're just buying the shares or the business and assets through a normal warranties and guarantees sale process. And it is always different, and there are always bumps in the road. And then it comes down to the right systems, the right management, as Louise says, to be able to manage that. But I mean, Carl, we touched earlier on the idea of you've got a plan, you've got growth aspirations. Is it normal to just hope, for example, that these acquisitions are going to come across your table, or what strategies can you put in place in order to try and identify the companies that might be ripe for acquisition, whether that be because they are going to fail because they haven't fared well through the pandemic and are in distress, or they're good companies, but maybe there are reasons why they are ripe for a sale.
Yeah, I mean, that's something interestingly that is becoming, you know, a service that we're seeing. So, you know, within the group, we've got market mapping, which is an off-market search service that will look for businesses, and will go, and there's such a lot of data available now at Companies House and the like, that you can really slice and dice that and find businesses that fit the criteria you're looking for. Comes back to Adam's point, you've got to have a focus in terms of what you're trying to achieve, and then you can find businesses off market. In terms of on market, then it's a question of registering your interest with sort of corporate finance houses and lead M&A houses that are going to be asked to sell these businesses. So there are ways you can definitely, you know, put yourself in a position where you're going to see these opportunities come across your desk. And then, you know, to come back to Louise's point, it's about having the discipline and the skill set to make sure that you make that a positive process, rather than being swamped with all sorts of information and chasing all sorts of, you know, dead ends and really wasting time on deals that aren't going anywhere. Now, there's no science to what's the right deal or the wrong deal, and sometimes a very unpromising start can lead to a transformative deal, and other times what looks like a great deal on paper just doesn't work out. So, you know, I think nobody's going to be able to give you a template as to make the perfect acquisition, but there are ways that you can improve your chances, both with a deal in terms of the sort of advised deal that Adam was talking about, or off market if you've got the right sort of advice and data set to work with.
Thanks, Carl. Well, the good news is for all of you that I don't get to put you on the spot with any Q&As from the. Oh no, one's just come in. Right. Okay. We have a question. I'm going to read it and then check who I should be asking it to. What about your corporate social responsibility of the acquirer? A customer might only want to buy from a company with good social responsibility, green issues, for example, the same as a key supplier. Reputation is key. Adam, do you want to handle that one?
Yeah, for sure. Most of the work we do is working for sellers. The interesting thing is, you know, from a seller's perspective, they can set out precisely the terms upon which they're inviting an offer for their business. What we generally find is that there are good buyers. You know, we'll receive offers, and then the client will meet a number of buyers, and there's generally people that we just class as good buyers. They come across well, they say the right things. They generally will indicate how they're going to, what they're going to do with stuff, be open and honest about that, and you know, generally be fairly transparent about the way that the deal is going to come to pass, and have a track record of showing that they've done that. So in this particular example of corporate social responsibility, if that's an important factor from the seller's perspective, then they're perfectly able to invite offers based on that. You know, it doesn't just have to be that fact. It could be anything from I want all of the staff to be well looked after for a minimum period, or I want to disappear and, you know, start a competing business the next day. You can invite offers on any business. But yeah, the interesting thing is we are seeing, you know, that side of matters becoming increasingly important, maybe even willing to take a lower price in order to meet some of those softer criteria. Thanks,
Adam. So, I mean, well, my easy summary is don't do any of this without the right advice. That's where I always get to on these things. You know, for management teams embarking on a journey, there's always that tension of trying to do it on their own and save money versus actually where's the money well spent, and clearly making sure you make the right choices at the right time. And for example, with Holly and the tax incentive scheme, the share ownership, it makes sense to get these things in place at the right time and get the advice on the strategy you go along, and indeed keep revisiting it in order to keep your focus on that end goal. That is all we have time for, I'm afraid. I think we're a touch over, actually. I will get a slap on the knuckles later. Thank you all so much to all of those who have joined us. Please do take some time to have a look at our upcoming event schedule, which can be found at k3hub.co.uk/webinars-events. And lastly, thank you very much to Louise, Adam, Holly and Carl for taking the time to share their knowledge, expertise and experiences. I do hope that if you haven't already had a holiday in this sunny and rainy summer, that you do get one before the month. Yes, the next month is out, August. But in the meantime, everybody, please do have a great weekend, and we will see you soon.